Foreign institutional investors or FIIs are on a selling spree in Indian markets. In the first half of May alone, FIIs have pulled out close to 37,000 crore from the cash segment. Now this is the highest ever monthly outflow in the calendar year, and the second highest is January of 2023. So why are foreign institutions exiting Indian markets, and more importantly, will this exodus continue? Hi, you are on News9 Live. I am Suyash Maheshwari, and if you like this video, hit the subscribe button to get more such insightful videos. Now let's get back to the issue at hand and start with what is perhaps the biggest factor of them all, or perhaps the most talked in the financial circles: election uncertainties. Now the volatility in financial markets ahead of elections is well documented phenomenon. Why? Because it brings uncertainty into system. Who will come to power? How big the majority will be? What sort of a policy changes will they bring about? All of this leads to increased speculation and fluctuating sentiment. You see, the markets are okay with negative news. What they are not okay with is surprises. And with the inkling of a surprise or an unexpected event is what is making them volatile. If you want to know more about how elections lead to uncertainty and can cause a market correction, our video explaining all of it is in the description below. Now let's talk about the other not so discussed factors at play. What do FIIs currently own? From 1990 to 2015, foreign institutional investors primarily focused on the consumption and IT sectors. But over the last 4 to 5 years, these areas have not been performing too well. And now, with the policymakers shifting their focus towards investments rather than consumption, FIIs have found themselves in a tough spot. So whenever the market is rallying, they are using those opportunities to sell their investment in consumption and IT sector, and looking to park that money in perhaps sectors with better potential like infrastructure. Factor number 3, decoupling from global equity markets. In the first couple of weeks of May, we saw sudden divergence in performance between world equity markets and Indian equity markets. While Wall Street and other emerging markets were hitting new record highs, Nifty and index of India's 50 most valuable stocks crashed by 1,000 points or over 4%. Since global markets are outperforming Indian markets, FII sell-off could potentially be tactical or strategic in nature, and should not be considered a reflection of their belief in the long-term potential of the Indian markets. Factor 4, China on the mend. In the last couple of years, Indian economy and our market has hugely benefited from the world slowly moving away from China. From being one of the contenders among multiple countries in the China plus one strategy, India is now the only one. However, a string of strong data releases in China show that the economy is now on the mend. And this again is causing FIIs to reallocate their funds. And finally, the age-old market adage, sell in May and go away. Sell in May and go away suggests that traders are considering selling their stocks in May and parking their money in bank and then re-entering the markets in November. Now the rationale is that since markets typically don't see a significant gain or loss over the summer, staying out can help protect your cash. And it's not just a saying. I mean, in last 4 out of 7 Mays, Nifty has in fact delivered negative returns. The worst performance for the index came in May 2020 when Nifty corrected about 2.8%, followed by May 2022 when the index gave away close to 2.5%. Even this May till the 17th, the index has fallen about 0.5%. So should you copy what FIIs are doing and sell in May and go away? After all, it makes all the more sense to follow the smart money, right? Well, according to experts, FII activity doesn't hold as much sway in the Indian markets as it did just a few years ago. Take April for instance. FIIs pulled out 35,000 crores, yet Nifty still rallied over 1% and hit a record high. We saw a similar trend in February and January of this year as well, with FIIs selling off but the markets still continuing to reach new heights. Also, FII selling has been more than compensated by rampant buying of our domestic institutional investors who have been net buyers in the cash segment since August of 2023. Ultimately, the market strength transcends FII actions, suggesting broader factors at play in shaping its trajectory.